analyst Mark Todd from FIG Securities in Sydney. Mark, firstly on this idea of more rate cuts here at home in Australia, we just heard from Bill Evans. He denies that he is the reason that stock market bounced yesterday, despite what was said in the Financial Review this morning. But do you think there is a growing sense that we can't see higher interest rates considering what's going on?
Hi Brooke. I think the first thing you do is give Bill the credit that he deserves, and it was a big call at the time. I think the month after it, ANZ came out and said rates are going up. So, you know, I think he's done pretty well in picking this. He was consistent in that he said if the global markets don't get themselves organised, there's going to be a crisis of confidence. He followed his previous confidence numbers and said, look, we're going to see a big rate cut in the December. So, you know, looking at today's numbers, it's pretty clear that most commentators would say there's not going to be any rate rise. Certainly this year, and I don't think next quarter will show it. I don't think first quarter 2012 will show anything yet. So,
but are you actually expecting rate cuts?
Yeah, I would have thought there'll be the anticipation in the market. You know, if I speak for the market generally, they're all thinking that there's going to be now a rate cut. You know, that's sort of embedded in the attitude. So if you see, you know, the major trading banks dropping their mortgage rates, if you're seeing deposit rates being reduced, price action, the behaviour of the banks says that they're all pointing towards the expectation is going to be a cut.
Because we have been talking about the fixed rate mortgages which are being ratcheted down by 3 of the 4 major banks so far. What are you seeing in term deposits? Should we expect the same there? Have you seen it yet?
Yeah, well, you're seeing the initial response was a lack of demand for money, so you'll start to see those rates starting to move down, maybe in the short end, in the 1 month, 2 month, 3 month, continuing to move those down. So it's a function of where those fixed rates are. The fixed rate was a function of where the swap market moves. So what happens is that if the swap market rallies 30 or 40 points, you can afford to offer lower rates because you're going to lock in your margin. So what we'll tend to see is 1, 2, 3 and 4 months being less popular. Still see a little bit of demand in the 1 year. We've got some good 6-month rates today at 6%, but I think over time people will start to move further down the curve, and that'll, you know, it'll supply and demand. It'll push these rates a little bit lower.
And when it comes to the banks themselves and the current worries about what markets are doing, basically, do you think that our banks have a good enough buffer, I suppose, to handle any kind of crisis that might come?
Yeah, I think there's a significant number. When you think about in the GFC, they were 52-48 against, so they were 52% of the funding was in wholesale markets, overseas markets. That switched around to 52-48 in favour. So therefore, you're getting most of your money coming out of your deposits. It's a manageable asset to, you know, the funding source. I still think, you know, we saw Westpac went out last week, I think it was on Wednesday, and issued a 1.5 billion in yen, 1.5 Aussie equivalent in yen at great rates. So there's still good support for our banks, but I think they like the fact that they don't have to go to the market to get money from offshore markets.
Mark Todd, I've gone way over time on the bulletin, so I have to thank you there. I didn't get through what I wanted to get through with you, and that was the Fed Reserve, but I know we'll chat with you soon. We'll do it then. Thank you.
Get it next week. Bye-bye.
Thank you. Cheers. Mark